The PCE is heating up again. This time, the risk does not lie across the entire technology sector. It is concentrated in one category of companies: the weak tech stocks that rely solely on rate cut expectations, AI narratives, and valuation speculation. We should continue to pay attention to technology stocks. Capital will no longer unconditionally chase tech names. The latest PCE data has not ended the tech sector rally. It has merely pushed the tech stock segment to a watershed moment. We need to avoid weak tech stocks, those without robust cash flow, without margin support, and those that depend only on rate cut expectations and bond issuance to stay afloat. No matter how much such stocks have fallen, for now, they are best avoided. Micron's strength, by contrast, represents those companies with solid cash flow, the ability to meet AI supply chain demand, hardware pricing power, and real orders. The differentiation pressure brought by the PCE has actually pushed these fundamentally strong tech stocks down to more attractive and worth watching price levels. That is my screening criterion after the PCE. PCE stands for the Personal Consumption Expenditures Price Index. In simple terms, it reflects how much prices have actually increased for US consumers when they buy goods and services. BEA data shows that the PCE rose 4.1% year over year in May 2026, while core PCE rose 3.4% year over year. Reuters also reported that the May PCE exceeded 4%. A high PCE indicates that inflationary pressures have not truly subsided. If inflation does not come down, the Federal Reserve will find it difficult to cut interest rates quickly. The slower the rate cuts, the greater the pressure on high-value tech stocks that rely on low interest rates and bond finance valuations. Previously, the market narrative was that inflation would decline, the Fed would cut rates, liquidity would return, tech valuations would recover, and AI and semiconductors would continue to rally. That narrative has now been broken by the PCE. A high PCE dashes the market's hope that, quote, low rates are coming back soon. If low rates do not return, the market will no longer indiscriminately reward all AI concept stocks. At this point, the question changes. After a tech stock falls, what will drive it back up? If it can only rely on rate cuts, it is fragile. But if it can rely on revenue, gross margins, free cash flow, and real demand, then this decline is worth a closer look. QQQ and SMH are only background references. QQQ reflects the overall sentiment in tech stocks, while SMH indicates risk appetite in AI and semiconductors. But the focus is not on the indices. My primary focus is on MSFT, NVDA, and MU. First, MSFT. Microsoft represents the large cap tech companies with strong cash flow. It has cloud operations, Office, enterprise clients, profits, and free cash flow. Microsoft is not a weak tech stock, yet even it has been pushed by the market to near one-year lows. As the WSJ noted, behind this is market concern about when the massive AI infrastructure spending by tech companies will yield clear financial returns. This shows that the market is beginning to re-examine the return cycle of AI investments. Previously, the market was willing to assign valuation premiums just because big companies ramped up AI spending. Now the market asks an additional question. When will the money you spend start generating returns? Precisely because of this, MSFT is the first type of opportunity to focus on. The PCE may suppress valuation speculation, but for a cash flow leader like Microsoft, what truly matters is whether its AI spending can continue to translate into cloud revenue, enterprise software revenue, and free cash flow. Second, NVDA. NVDA represents the core demand for AI. In this AI trade, the market may doubt many companies, but on the main thread of AI, computing power demand, NVDA remains the most representative core player. As long as AI data centers are still being built, and as long as demand for large model training and inference continues to grow, NVDA will remain a core asset that capital cannot easily bypass. A re-accelerating PCE will pressure high-value tech stocks, but those core AI companies with real orders, real revenue, and real pricing power are still the most likely directions for capital to rotate back into. Third, MU. MU represents AI memory and HBM pricing power. HBM stands for high bandwidth memory, which is a critical bottleneck in AI servers that supports GPU operations. In the second half of the AI race, the focus is not solely on GPUs. It also depends on memory, bandwidth, server bottlenecks, and data center infrastructure. MU should not be viewed merely through the lens of the traditional memory cycle. It needs to be evaluated based on whether, as AI server expansion continues, memory and bandwidth can remain a scarce link in the chain. NVDA represents the core of AI computing power, while MU represents the bandwidth bottleneck behind that computing power. Within the AI concept sector, companies that emphasize concepts and algorithms, those that are primarily storytelling, should be avoided for now. The real focus is on three types of strong tech stocks: MSFT as a cash flow leader, NVDA as a leader in core AI hardware demand, and MU as a representative of a key AI infrastructure bottleneck. After the PCE reaccelerates, capital will concentrate on the strong players. Valuations will return to reality. So this PCE reading above 4% is a signal to rescreen tech stocks. Going forward, the stocks that capital will truly buy back into are those that can demonstrate cash flow, profit margins, real demand, and tangible AI revenue realization. This is an observation framework, not investment advice. Do not chase news headlines. Only track the directions where capital is truly willing to place its bets. Do you think tech stocks represent a bottoming opportunity or a valuation trap next? Share your thoughts in the comments.